Hey guys, welcome back to our channel Accounts Guru Cool. Learn accounting online. So today we are here with a new video, and this video we have created based on the viewers request. And in this video, we are going to discuss about how to create the bad debts provisions as per IFRS 9. That's International Financial Reporting Standards 9 bad debts provision calculations. So we are going to first understand, so what's the IFRS 9 says about all these reporting standards and to which entity it's going to be applicable. And in India, uh, giving some examples of the few MNCs or entities who are using the IFRS 9 or IFRS. So that also we are going to discuss about that. So based on that, we are able to know that which type of industries team the working in that type of industries is going to be applicable to learn about the IFRS 9. And we are going to take the example as well. And based on through these examples, we are trying to explain how it's going to be work. So it's great for everyone to know that how the IFRS 9 is going to be work into the bad debts provisions and how we have to do the calculations that we are going to discuss in this video in detail with the one of our examples, and that's on the practical examples we are doing into the Excels with all the steps. So it's useful for everyone to know how it's going to be work. Now coming back to the applicability of the IFRS 9, then how was the IFRS implemented in India? So if you see here, the India has not adopted IFRS standards for reporting by domestic companies, however, has issued a formal roadmap on how it will be implemented. So as of now, it's not that much adopted by the domestic companies, but they have already created the roadmap how it's going to be implemented, and all the companies with the net worth is INR 500 crores, that's US dollar 72 million approx, and companies having a net worth of INR 250 crores, that's US $3.360 million approx. These are all going to be implement this IFRS. And which company adopted IFRS in India? So as of now, giving some examples of which MNCs has already been adopted the IFRS in India. So the list of companies includes IT firms like Wipro, Infosys Technologies, and NIIT, automakers like Mahindra and Mahindra and Tata Motors, textile companies like Bombay Dyeing, and pharma firm Dr. Reddy's Laboratories. So these are all the some examples where these MNCs has already adopted the IFRS and they are doing their reporting as per the IFRS. That's International Financial Reporting Standard. Which companies are required to follow IFRS? IFRS are required to government-owned enterprises. So it's going to be required to adopt for government-owned enterprises, newly privatized companies, large taxpayers, banks, and insurance companies. IFRS is required to both consolidated and separate financial statement of financial institutions. IFRS is permitted to both consolidated and separate statement of other companies. So here, if you see that, so as of now, the IFRS is not that much fully implemented into the India, but the roadmap has already been created, and that's going to be implemented throughout across all the MNCs or all the companies. So now, to know that wherever it's has already been implemented and going to implement, there are certain turnover limit is already there, and based on that roadmap, we are going to adopt this IFRS for doing our financial reporting. So now, through these examples, we are trying to explain you how it's going to be work. So we have created the one examples as well, and before moving ahead to the numbers that we have used, all these numbers is just for an example. So don't think that the accounts Gurukul has that much turnover, but yes, if you guys with us, then we will think for that. But as of now, we have just created the accounts Gurukuls as one of the entities, and whatever numbers we have mentioned here, that's numbers is based on the just example for viewers to know that how it's going to be work. So we'll discuss about the IFRS 9 through the example, how we have to create the provisions in the books. And if you see in our uh, earlier practice, or the team who's working into the account receivable team or finance teams, they used to create the provisions, or the team who's doing the audit. So they just pull out the aging for the account receivables, and based on that aging, they used to do the provision into the books for the bad debts provisions. Giving example is that if the any bad debts is more than 360 days, then they used to provide that entire amount as a provision for bad debts. But there might be what we are thinking, that's 31 to 60 days or 61 to 180 days. That's our good debtors. There might be some bads is already hidden in that good. So that's we are going to understand through the International Financial Reporting Standards 9. So now if you see here, Accounts Gurukul wants to calculate the impairment loss of its trade receivables as on 31st March 2022. Accounts Gurukul's policy is to give 30 days for the repayment of receivables. So here the accounts receivables is giving the 30 days credit period to do the payout. And now we just need to know that how the impairment loss we have to create on accounts receivable as on 31st March 2022. Note, this is an important point. The 30 days credit period means that these receivables have no significant financing component. So we are considering that the 30 days as a credit period. So within that 30 days, it's not going to be impact into our receivables, because that's our allowed credit period. Now, if you see here, the aging structure of our trade receivables as on 31st March 2022 is as below. So days after issuing the invoice, that's within maturity, that's a 0 to 30 days is a 5 lakh. 31 to 60 days, outstanding is 1,25,000. 61 to 180 days is going to be 1 lakh, and 180 to 360, that's a 62,500, and greater than 360, we are showing that's a 50,000 is going to be outstanding, or 50,000 is outstanding. So the total outstanding as on 31st March 2022, since we are going to complete 31st March 2022, but still we have just considered this for our calculation purpose. So the total outstanding of account Gurukuls into the market is around 8,37,500. So that much is the amount is yet to receive from the market. And the aging criteria or aging bucket of that has already been explained. That's 30 days, 3160, 6180, 180, 36, and beyond 30. 360 days. Now, as per this IFRS 9, we have to follow the some processes, and there are some two types of bad debts provisions we have to create as per the IFRS 9. That's the one is a general practice, and one is a simplified approach. That's the one is general approach, and one is simplified approach. So here we are going to discuss about how it's going to be worked through the simplified approach. So before going to start, if you see what processes we have to follow to calculate the IFRS bad debts provisions as per the IFRS 9 is that the step 1, analyze the collection of receivables by the time bucket, calculate the historical loss rates, incorporate forward-looking informations, and apply the loss rates to the current trade receivables portfolio. So that's going to be based on our own analysis, how it's going to be collection receivables by the time buckets. So we have to identify if you are going to do the bad debts provisions based on the IFRS 9 for the financial year 1st March 2021 to 2022, then we have to analyze how the collections of our whatever we have done the sales, and based on that we have to identify how it's going to work. And the second calculations we have to do the historical rates. We have to recalculate how much is the calculate the historical loss rates for previous year, and we have to do the forward-looking approach as well, how it's going to work, and then we have to apply that loss rates to the current trade receivables portfolio. So we have to do the calculation based on these 4 steps. Now, if you see here, the Accounts Gurukul decided to apply the simplified approach line with IFRS 9 and calculate impairment loss as lifetime expected credit loss, LECL. That's lifetime expected credit loss, how it's going to be for impairment loss for life expected credit loss lifetime. So now if you see here, as a practical expedient, Accounts Gurukul decided to use the provision matrix. And in order to have sufficient historical data, Accounts Gurukul selected the period of 1 year from 1st April 20 to 31st March 2021. During this period, Accounts Gurukul generated credit sales of around 50 lakh. So as per the steps, if you see here, the calculate the historical loss rate. So now we are going to calculate the historical loss rates, how it was for the earlier period. So now during that period, Accounts Gurukul generated credit sales of 50 lakh. So here the step 1 is that's going to be talk about. If you see here, so we have to do the first step, and that's analyze the collections of receivables by the time buckets. So here the Accounts Gurukul needs to analyze when the receivables were paid and sort them out into table based on the number of days from creation of invoices until the collections of receivables. When it's paid amount cumulative, and unpaid amount. So here we are taking the examples based on the past years, how it's going to be work. So within the maturity of 0 to 30 days, that was 15 lakh. The paid amount cumulative is 15 lakh and unpaid is 35 lakh. So that's going to be 50 lakh minus this 15 lakh. So outstanding is 35 lakh. Similarly, on a 31 to 60 days, the paid amount is 13 lakh. So the total cumulative is 28 lakh and the unpaid amount is 22 lakh. Similarly, for 61 to 80 days, that's 12 lakh. The paid cumulative is 40 lakh and the unpaid amount is 10 lakh. Again, for the another bucket, 8 lakh was the paid amount, 48 lakh is cumulative amount, and 2 lakh was the unpaid amount. And this 2 lakh is beyond 360 days. And we have parked that as a 2 lakh as a write-off for the previous year. That's from 1st April 2020 to 31st March 2021. So the total is 50 lakh. So the first step we have calculated is based on the analysis of the previous data, how much was the sales, and against that entire sales, how much is the amount received, and as per the stages, how we collected that amount. The second step, that's calculate the historical loss rate. Now, Accounts Gurukul can calculate the historical default loss rates as the loss amount of 2 lakh divided by the amount of unpaid outstanding at the end of the each time bucket. So when paid, that's unpaid amount, loss, and how much is the default rate. So within the maturity of 0 to 30 days, that 50 lakh was the outstanding, considering that the 30 days is a credit period. So 2 lakh is the total loss. So default rate is 4%. And the default rate is calculated based on the loss divided by the unpaid amount. So similarly, for 31 to 60 days, 35 lakh was the unpaid amount, loss is 2 lakh, and the default rate is 5.71. So we have calculated like this, how much is the default rate on each stage. The default rate is loss divided by the unpaid amount, and you have now calculated the historical loss or default rate. Now, you need to incorporate the forward-looking information. So to do the calculation as per the IFRS 9 bad debts provision calculation based on simplified approach, we have to follow the steps. That's first is analyze the collection of receivables time bucket. Second, we have understood calculate the historical loss rate. Now the third step, that's going to be incorporate forward looking informations that we need to know how we have to do the calculation for that. This is a more difficult, but we will outline one very simple approach. Let's say that Accounts Gurukul's credit loss shows an almost linear relationship with unemployment rates, and if the unemployment rate may not be a suitable factor for your business, you should find your own in in macroeconomic factors that could affect your credit losses. Let's say that the statistical office in accounts Gurukul's country assumes that unemployment rate will be go up from 5% to 6% in 2022. Accounts Gurukul experience is that when unemployment rate increase by 1%, it triggers the increase in default loss by 10%. If your unemployment rate increase, then it's going to be impact on our receivables by the 10% if it's increased by 1%. Therefore, accounts group pool may reasonably assume that the loss of 2 lakh will increase by 10% because of the increase in the unemployment rate. So the amount written off will increase to 2 lakh 20,000. That's the 10% of 2 lakh is 20,000. So total written off will increase to 2 lakh 20,000. So you adjust the calculated loss default rates by the forward looking informations is as below. So within the maturity, we have collected 50 lakh. The loss is 2 lakh 20. Then the default rate is 4.40%. Similarly, for 31 to 60 days, it's a 6.29. For 61 to 180, it's a 10%. And for the 180 to 360, it's a 22%. So as per this third step, incorporate forward-looking informations based on the different criteria, what is going to be impact in our collections that we have to factor in, and based on that, we have to calculate the default rate. Now, the last stage, apply the loss rates to the current trade receivables portfolio. You then apply these losses rate to actual portfolio to trade receivables as on 31st March 2022. So this is our actual outstanding is 8,37,500 and within the maturity is a 5 lakh. Then the loss rate is 4.40%. Then expected credit loss is 22,000. So here for 31 to 60 days, it's showing 7,857. And for 61 to 180 against this 1 lakh, the 10%, 10,000 is there. And similarly for 360 days, 50,000, that's 100% is going to be around 50,000. So total against this 8,37,500, we have to create a provision for bad debts as per the IFRS 9. That's expected credit loss is 1,03,607. So here the accounts group can recognize the impairment loss on trade receivables is debit to P&L impairment loss on trade receivables is 1,03,607 and credit bad debt provision that's 1,03,607. So this is all from this video, and we learn from this video is that how the IFRS 9 bad debts provision calculation is there based on the one example. And we know that we have to follow the 4 steps. The first is going to be talk about based on our previous data, how much is the historical collections and how much is the total write-off. And based on that, we have to add some future predictions based on our business, how it's going to be and how it's going to be impacting our collections. And we have to derive the default rate based on the forward approach. And then that default rate we have to apply for our age outstanding, and we have to calculate the expected credit loss, and we have to take the entry for that impairment loss on trade receivables and hit to our P&L account and credit to bad debts provisions. So this is all from this video. And having said that, this video as well we have created based on the viewers request, and request viewers to put it in the comment if you want we to create any more videos for you. So thanks guys for watching the video till the end, and request viewers to like the video, share the video and subscribe our channel to get the more practical knowledge related to accounting and finance. Thank you.